What's up, everyone? Hope you guys are all having a fantastic Thursday evening. It's about to be Friday, going into the weekend. I gotta work tomorrow, unfortunately. But tonight, I'm gonna be doing some live trading and go over how I am using the Strat to make real time decisions in the futures market. I am currently in a trade right now. It's not looking like it's going to work out, so I might exit it. Let's see, there we are. Let's get the frame back in there. Okay. So as you can see, my trade is currently in the S&P. It's kind of an impulsive trade because things looked like they were setting up when I saw it. I don't think this thing's going to go down like I thought it was going to go down, so I'm going to take my three
Order
ticks and
filled.
get out of here. There's probably not going to be much price action. Let's see. There's probably not going to be much price action, any big movements, drastic movements while the stream's on air. But I'm just going to talk about what I see. I'm seeing the markets right now. Yeah, so what do I look at? What am I looking for when I am trying to look for setups in the futures market? How do I filter out different setups or whatever? So I have a trade plan right here. I built this trade plan with basically using Futures Trader 71's his methodology for developing trade plans and business plans for trading. I highly recommend that any newbies go through his convergent trading, his course or whatever you want to call it, his online profit environment. I think that's how he describes it. I would say that's a pretty good description. I've spent about 2 months in there, well worth the money. So that's how I've developed this. I obviously trade the Strat. So I've applied his methodology, Futures Trader 71's methodology, to develop my trade plan, and this is what I've came up with so far. And actually, this structure for developing my trade plan that I have right here, the way I have done this specifically was by using Oliver Velez. He has a video where he describes all the necessary pieces that you need to execute on a trade. So it's a little bit of both. It's a little bit of Oliver Velez, a little bit of Futures Trader 71. But the idea here is that we're taking all the necessary elements that we need for a trading plan and we're mapping it onto the Strat. So the first thing that I see that is needed in every single trading plan is context. Or maybe context is the wrong word for this situation, but what I'm looking or what I need in a trading plan is the ability to develop a narrative. So as you guys can see here, I have all the building blocks that I use to build my narrative when I'm looking at charts. So I use pivots to signal exhaustion, wicks tell me about trapped participants, actionable signals that tells me about how I think buyers or sellers, what happened to them on the previous bar, whether they got stuck short, whether they got stuck long, on a hammer or shooter candle. Again, back to the wicks being trapped participants, inside bars being two-way battles, mother bars meaning that we're inside noisy price action, triangle layout is corrective activity, time frame continuity tells us about the higher time frame objective, and we won't look at that right now. So that's piece number one of a trading plan using the Strat context. This is what I use to develop a narrative. So let me pull up what we're looking at right here. So this is a pivot right here. This is a pivot right here. So we all know what we're talking about. And, using our context, like let's say that we hadn't seen this price action yet. And we're currently inside what we have going on right here. So after this pivot is broken, with our little cheat sheet that we have going on, that tells us that our narrative is that there could be some exhaustion that we're signaling. Once we break this pivot, we do, this thing could run for quite a while. But just from experience, I get the feeling that, when we break pivots, there's a high likelihood that price is going to reverse and come back down. So that's kind of how we're looking at narrative or context. We got these long wicks right here. That tells me that there might have been a lot of people who got stuck short. So when we have people who get stuck short, that means that there are going to be a lot of buyers needing to cover their trade. And we're likely to have bars like this. So that's what I have for context using the Strat. This is kind of how I build my narrative when I am watching charts. And just using these really basic cheat sheet. Pivots mean exhaustion. Wicks mean trapped participants. These things either are happening or they're not. You know what I mean? It's not like, there's either a good wick in the picture or there is not. We are either experiencing corrective activity or we are not. We're either inside a mother bar or we are not. So these are really useful tools. It basically gives you all the building blocks to create a narrative of the market that we are currently in right now. So that's what I'm using. Time frame continuity principle. The more time frames in our favor that are going in our favor, the better the trade, the more likely the trade is going to work for us. Let's see what's going on right here. Okay. In the Strat, our setup is the broadening formation. That is our number one goal in any trade using the Strat, is to complete the broadening formation. So what does that mean? A broadening formation is when we take out the high of a range and when we take out the low of a range, or when we take out the low of a range and then come back and take out the high. That is a broadening formation. So we have a broadening formation right here. Took out, so we have this range, took out the high, came back down, took out the low of the range. We completed the broadening formation. Have a broadening formation right here where we came up and came back down, took out the low. And this is actually an incomplete broadening formation. A real one would be if we took out the high right here, take out the low. Let's see, where do we see another broadening formation? Okay, here we have broadening formation. Have this range right here, take out the low, which is right here, came back up, take out the high. Now I'm cherry picking right there. You guys obviously see that. I understand hindsight's 20/20, but that's the goal. We're trying to complete these little triangles. Triangles. That's all we're trying to do is complete triangles. Which makes our life a lot easier if that's all we're doing is trying to complete the triangle. So those are our setups. Our setup is to complete the broadening formation. Now, in the strat, a broadening formation is just a reversal. So let's a completed broadening formation. So right here we didn't quite complete the broadening formation, but we had the reversal. Or we completed. So this is why I'm saying pivots mean exhaustion. Once we get below this pivot, price may exhaust. It's not guaranteed to come all the way back down to the other side, but first pivot always has a pretty high likelihood of getting hit. So when we start getting to pivot 2, 3, 4, that's when we start getting ourselves in trouble. So pivots mean exhaustion. We want to take off most of our trade if we are in a trade right here. But we reverse, came back down, complete this broadening formation because this is a range. Took out the high, took out the low, weren't able to continue to complete this bigger broadening formation. But we still completed a broadening formation, right? So that's always the goal of what we're trying to do. Complete these bad boys. We got another broadening formation right here. And we did complete that one. We see that we have this range in between 41.57-ish and 41.85. We have this hammer candle, which is one of our actionable signals, something we use to create narrative on. Hammer candle. We have the wick, so maybe some possible stuck shorts. And then we come up, we complete the broadening formation. So you see what we're doing there. The strat gives us all the pieces that we need to develop our narrative and then make a decision. So that's what we're doing. That's what we're trying to do. So we have our setups. We're just completing the broadening information like I showed you guys. Really, really simple concept. And we're taking the context and then direction, and we're using those to help us filter out trades and get ourselves into really to good positions. For a trade plan, a good trade strategy, we also need to have stops and targets. So our stop is just one harmonic rotation. I just adjust these to the nearest swing high, swing low. I'll show you guys what I mean right now. So if I were to enter long right now, this is the chart that I execute on. I use some simple moving averages just for reference points on my execution chart. But let's say I were to enter long right now. I don't plan on entering long right now for a few different reasons. I'll get to those in a second. But let's say I were to pretend I would enter long. My stop is going to be below this swing low right here. I have a zigzag study. I think most of these zigzag studies come in different shapes and sizes on different platforms. This is the one I'm using. It's really nice. It kind of it's a line at the swing highs and lows, and those are really good guides to help you get on the right page. Let me get this out of the way. So yeah, my stop is going to be calculated with one harmonic rotation. I'm not going to explain what that is right now. You guys can look it up on your own. It's not necessary to trade the strat. It's just what I use. You can use an ATR. It's perfectly fine. But I mean, at the end of the day, it doesn't matter what the harmonic rotation is because this is the right stop. This is where I need to place my stop, is right here, because that's where I'm wrong. It's such a, like, the strat is so easy in that sense because we make our lives easy by placing things in good locations. Right here, the swing low. That's where we're getting out at. Now our targets are going to be at pivots. So a pivot, we got these little dots at the swing highs and lows. That's all it is. It's the swing highs and the swing lows, and it's the obvious ones. Like these ones are all kind of clustered together. I'd kind of count this guy up here, this top pivot, as the main pivot, or probably these guys right here where we're all centered on. We got like 5. That's probably actually the best pivot right there, because once we break that, if we fall back through, that's where we're going to get the exhaustion at. We're not going to get the exhaustion from this guy. We might start exhausting right there, but the thing that's going to cause the exhaustion is to break this level. So that we are going to exit our trades at major pivots. So we got a major pivot right here. This is a good pivot right here. It's not one that we would discount, but let's say we're only trading 1 or 2 contracts. My 2 targets would be right here and right here, right? So that's how you choose your stops with the strat. Again, these are elements of a trade plan that every trader has and every trader uses, but they're pretty clear as day, spelled out very usefully in the strat. So that's why I'm sharing this with you guys, because the strat is really nice because it has everything packaged up really nicely. It has everything that you need for a trade plan packaged up really nicely, and a beginner can grab this and run with it. They can run with it really, really easily if they want to. But it's trading has a lot of psychological stuff that comes with it and makes that type of stuff really hard to, be successful at it really right away. But the strat has everything that you need to trade right almost instantly, but you have to behave. You have to behave as a trader, and most traders don't learn that. They don't learn that as a beginner. I know I didn't, for sure. All right. So we have how we set our stops and targets. That's pretty clear. Another thing before I move on, I just want to say, you want to, because our stops and targets are objective, at any position, if I want to enter a position anywhere, I just need to look at my nearest swing high or swing low, and then the nearest pivots, and I have my stops and my targets. Like, it's not a question. I don't have to think about it. On any chart, let's do something else like British pound, so I can show you guys an example. Let's say I were to go long right here. My stop would be under this low. My target would be probably right here, and then for the next target, we don't have another pivot until, up here. I might front run it, bring it down here. But we have our candidates, right? And what we need to make sure of when using the strat is, because our targets our stops on our target are preset for us, we don't have to think about it. What we need to do, I'm going to get into this. Do I want to get into that?
Order filled.
We'll see if this is a bad trade. You guys can see. Set it above pivot. And go for this pivot right here. Trade a setup. Now, this is the point that I was going to make to you guys when I got distracted right now. When you pick a trade, you need to make sure that your pivots are far enough away from your entry to make the risk reward worth it, to make this a trade worth taking. If it's not, if let's say your stop was way up here and then your targets were like way down here and it was like less than a 1-to-1 risk reward or something like that, you're going to want to ignore those trades. And like, let's say that there's like a bunch of pivots right here in the way and the stop that you would need to take is really far away, and that type of thing. I mean, that's pretty objective, pretty clear. So you kind of want to steer clear of those type of trades. And then, so the rest of the stuff I'll kind of just go over as I go through it. So I'll pull this up, 1 tick in the profit. So my trade management plan. So I move my stop loss to break even as the trade reaches 1-to-1. 1-to-1 risk reward. Let's see how many ticks this is. So 4 ticks away. My stop is 4 ticks away. So once this trade reaches 1-to-1 risk reward, which is 4 ticks in the profit, I can choose to move this to break even. I don't like to do it too early, so just depending on kind of how I feel the trade is working out, I might move it to, so I'm definitely going to move it down to the reversal point. The study I'm using draws out a reversal point. But probably around maybe 5-6 ticks, I'll probably move it to break even just to give this trade enough room to breathe. Probably going to front run this down right here. So this is 2-to-1 risk reward right now for this first target, because my max risk on this trade is 4 ticks. Max reward for first contract is 10 ticks. Good trade. Statistically, should be a pretty good setup. So yeah, that's what I'm going to be doing with my stop loss. Once I get to 1-to-1, I'm going to be adjusting it to break even, and then that's a free trade at that point, and I can let the trade run. So I'm massaging the R factor of the trade as it progresses. Okay, the next part is manually exiting positions. So when am I going to manually exit a position? Just, evacuate, get out of this thing. This trade is not going according to plan at all. On reversal on my intraday charts, so my intraday charts are the 15, 30, and 60-minute chart. So that's these guys right here that I have on. If this trade reverses on me going long, like it's looking like it might do right now, I don't think so. It was just 1 tick. But if any of these charts give me a reversal signal against my position, that's a manually exit. We're going to manually exit. Don't let trades that I've reached a greater than 1 R factor turn into losing trades. It's another rule on manually exiting a position. Profit taking rules. We're going to exit the first contract, first unit, at either 1 to 1.5 R factor. Depending on the trade, where the pivot is, we might exit a little later, 1.5 to 2 at the max, but I try not to do that. I want to put some money on the table between 1 to 1.5 R. Second contract, I'm going to front run the major target that completes the Brownian formation. I use about 2 contracts typically. I'm not good for some reason when I do 3 scale outs. 2 scale outs seems to be fine. 1 at, first target, second at second target. Yeah. And then the nuances to my trading plan, I execute off the 3 to 5 minute chart. I find my setups on the 15 to 60 minute chart. Oh wait, I'm not even showing you guys this. So this is what I was just talking through right now that I kept out of the frame. So I'm finding my setups on the 15 to 60 minute chart. And again, guys, this is in the futures, on whatever futures contracts that it is. This is the plan that I'm using. This is what seems to be working for me so far. So if you guys are wondering, oh, how do I trade the futures using this stuff? This is what I'm doing. It seems to be working. For time frame continuity, I want to see time frame continuity up to the 4-hour chart. It's not a make it or break it. Just depends on how I see things across the time frames. But it's better when we have time frame continuity up to the higher time frames, at least up to the 4-hour chart. So this is a big one right here. I want to plan my setups around scheduled or anticipated volatility. I kind of ignored that rule right here just because the trade looked nice. I'm currently 3 ticks in profit, so the trade looks like it's going to work. But I like to keep my powder dry until I'll give you guys a few examples. The European Open, economic releases, the U.S. session open around 7:30 a.m. Central Time. The U.S. has a bunch of economic releases a few times a week. And that's basically it. And the whole U.S. session kind of is like volatile compared to Europe or Asia. So if you find a setup except for during the lunch hours, you can probably play it just depending on what product you're trading. But I like to schedule my trades around volatility because otherwise, if you're trading just during the middle of Asia session or a European session that does not have many scheduled economic releases, the price really sits sideways. Like, it takes experience to understand this point, but price will just sit sideways and chop you up, and you lose so much money trying to make trades work that just are not going to work for you. That they just are not going to go anywhere. You can tell. I'll show you guys what I'm talking about. Like this is Asian session right now in the S&P. Look at how narrow that range is. You can tell. Like, the S&P is starting to do something right now, and the commodities are all kind of like starting to sell off a little bit, but not anything drastic. And the S&P not being a macro product or anything like that, it's kind of just sitting in this range, and it was doing a lot less prior than right now. It actually might interact with it right now, and you can kind of tell when it's just sitting sideways. Like, it's not just sitting sideways anymore. This is something that's new as of the last few minutes. This is probably going to sell off quite a bit actually right now. Just the way this is looking, along with all the market. The whole market is kind of looking like it's selling off. So that's how you can kind of tell when things are sitting sideways. When everything is kind of just doing this, when the Nasdaq and the Russell and then the Aussie dollar and crude oil and natural gas, when they're all just kind of not doing anything at all, um, that's when you want to stay out. It's typically during the Asian session, um, and you know might catch a break every once in a while, but the probabilities are low. So you kind of want to just, if you could just wait until Europe opens, wait until the U.S. session opens, wait until an economic release that you think is going to bring some big volatility. Wait and then execute the setup following the first minute or two of the release or the volatility once it drops. That is going to be it's going to make your life so much easier. I'm just telling you, um, don't try to trade during hours that have nothing going on. I'm telling you, don't try to trade during hours that have nothing going on. It just does not. Your life is so much easier when you just wait until Europe opens, trade for like 10 minutes. Your trade will be like 10 minutes if you're trading the futures, and then get out and then you're done. And then wait until the US Open, 6-7 hours later, and then take your trade. You're gonna trade for like 10 minutes, and then you're gonna wait until the next volatile hour. I also trade between that period between 2:30 p.m. Central Time and 3 p.m. That's also another good volatile time to trade for the S&P specifically. For the S&P or the Nasdaq or the Russell, those three products you can trade during that period. So that's my nuances to my plan. I plan setups around scheduled or anticipated volatility. Right now, I'm kind of breaking that rule a little bit. Okay, so now let me show you guys how the trade progressed. It's progressing. Let's get this out of the way. Not a losing trade anymore. And so it's 4 ticks of risk for this trade. Going to front run it by a tick. So yeah, that's one of my nuances to my plan. Trade around volatility. Right now things are picking up a little bit, and you can kind of see when it happens. You can kind of see, like, I don't know how, like, that's kind of more of an intuition, more screen time thing. You can see when volatility is picking up even outside of your hours. Volume's a good way of actually knowing whether the price movement was a fluke or not. That's actually a good way of telling, okay, this is actual volatility. We can see that we do have a little bit of volume relative to the rest of the session, not that big, but I mean, this is during China and Tokyo Open that we have this volatility come in right here. But this is a little bit of a bump up right here. And then everything is moving with it, so you can kind of tell this is real movement, not fluky movement. Boom, there we go. I'll take my
target filled.
And then, so you guys see how I kind of am playing this. And again, the goal is to complete the broadening formation. You guys see what we have right here. We have, let's see, Okay, so this is kind of what's happening right here. Took out a high, created a little bit of base, now following through. Now we want to take out the other side of this, complete the broadening formation. The broadening formations aren't always pretty. They're not always like to the letter, like, oh, like this barely made a broadening formation. The idea is like it goes up and then it comes back down, and it like has this like trading up, trading down pattern, and we're taking out pivots, we're taking out ranges. Let me show you guys the setup on the 15-minute chart. It's really nice, actually. So this is like to the letter broadening formation. Okay, so now we can see this much clearer on the 15-minute chart, the broadening formation. The goal is just to take out a high and a low. That's all we're doing. That's all we're doing. Trying to complete the broadening formation. So we completed this broadening formation. Let's see. We're completing it right now. And it's part of this bigger broadening formation right here. Right, that's the real big broadening formation. So where does this start? Why does this look all weird? Okay, so this is the hammer right here. Sorry, I have two charts up and I'm cross-referencing them, so I'm probably confusing you guys. Okay, so we are in a bigger broadening formation. Okay, so now looking at this on the 60-minute chart, that doesn't look like a high probability setup. Probably should take everything off the table right here. Because remember, pivots are exhaustion. So we have these two pivots to go through. And my other target is 1.1802. So I guess that's not too far-fetched. But we are winding up right here, so we need to be careful. We need to be careful. I'll show you guys what I'm talking about, the wind up. But I want to take out this for my main target. It's a free trade at this point, because I took profit off the table and my other stops at break even. And I really don't mess with the stop loss once the first trade has been hit. Once the trade has been hit, or once first scale out is hit, and once I move the stop to break even, I kind of don't do much with it because I want my buy limit order to be the one to take me out. I don't want my stop loss to be the one to take me out. a lot of the times, if it's a fast moving market, what I'll do is I'll take my limit order and hold it above the last price or the current price. And if this thing is like tanking and it like goes, and it's just like going super fast and just in a down direction, and then you start to see it wick, then I can release the mouse and it's going to market order at the place that it's starting to stall at. And it's just, to me, that is a really helpful way to kind of get those really fast, quick moves that happen out of nowhere. And really get the most out of those without letting it go against you once you back some profit. I'll show you guys later. Let's see. I'll run this a little bit. So it has about another 8 ticks to go. I'll take that. Okay, so let's see what else about my plan have I not gone over yet. So plan and setups are on its scheduled or anticipated volatility. Only want to take 2 attempts per idea. I have not mastered that one yet. I'm getting better at not taking silly trades anymore, though. Quite a bit better. 3 losses in a row earns a stop out on the session. I'm thinking about making this on that current time slot of volatility, changing it to that, because I really only trade that like half hour of really quick movements that we get during the European Open, during releases, and during the US Open. So if a trade does not set up during scheduled volatility, you are not required to trade. This took me a long time to understand. I always wanted to be trading every day, all the time. And like, you have to understand, are you trading because for the thrill of it, or are you trading to make money? If you're trading to make money, then like trading every single session is kind of silly if you don't know what you're looking for. Or if you're kind of just forcing trades. If you're at the desk, it's better to just shut everything down and walk away. Don't even tempt yourself. When you're tired or out of it, it's suggested that you do not trade. So again, another reiteration of that. And these are just trades that are instruments that are working really well with the strategy. So crude, the crude E-mini, the currencies, and the S&P all really work really well with the strategy so far. Nat gas, platinum, gold, copper, all products that I need to test. Get better at trading those using the Strat. $49, $5.53. It's probably gonna get to my target. This is what I love about this. It's like these. It's like you take out a high, and then when you start falling through, you get the actionable signal, the shooter candle right here, and you just kind of can see it. You're like, okay, now the goal. What's the goal? To complete the broadening formation. It completes. We completed a broadening formation. Step one complete. And now we're gonna continue completing this broadening formation that we made up started up here. So we're just completing broadening formations. It's that simple. It's that simple. That's why I love trading the strat. Let's see where are we at right now. I had some losing trades, so this is making my money back. Let's see what's the euro doing. Euro's a little bit weaker than the pound. Yen is really weak. Aussie is really weak. Just completing broadening formations, guys. You know, we have to be careful for exhaustion right here because remember what happens when we take out pivots. Price gets exhausted. So now the price is getting exhausted. I'm gonna hold my limit order above here in case things start to get a little hairy really quickly, because that's what can happen. Buyers can come in and just start buying it right up after you take out those pivots. Those are key levels. It really sucks. But the other currencies continue to go, continue to fall. Aussie dollar is doing that. Euro is ticking up right now. Hmm. Let it pull back a little bit. Really nice if this thing continued though. We're only 4 ticks away. It's gonna continue, I think.